60% disappeared in 4 days. On December 5th, 2025, silver touched $59.32 per ounce, a record, the highest price in 45 years. The financial media called it a rally. They called it momentum. They said it was safe haven flows and geopolitical uncertainty, and then they moved on. But here's what they didn't tell you. In the first 4 trading days of December, more than 47 million ounces of silver were claimed for physical delivery at COMEX. That's 60% of the exchange's total registered inventory. Gone in 4 days. Registered inventory is the metal available for delivery against futures contracts, the metal that makes the paper market credible. By late November, COMEX held approximately 113 million ounces in registered form. 4 days into December, more than half of it was spoken for. The remaining metal, what traders call eligible inventory, sits in vaults but requires conversion to become deliverable. That conversion doesn't happen instantly. It requires paperwork, logistics, carrier coordination. The public story will be that this was normal volatility in a commodity that's always been volatile. The devil's metal, they call it. Price swings are expected. Nothing to see here. That's not what actually happened. I'm going to show you why silver will reach $50 by the second quarter of 2026, not as speculation. As a mechanical outcome, I'll walk you through the math that futures desks are running right now. The stress tests, the gap risk calculations, the mark-to-market exposure that accumulates when registered inventory approaches zero while open interest stays elevated. By the end, you'll understand why this matters. Not because of price prediction, because of what happens when the assumption underlying a $100 billion derivatives market breaks. I monitor flows, cross-market basis spreads, delivery data, the kind of information that doesn't make headlines but shows up in clearing reports and warehouse receipts. When you watch these markets long enough, you learn to distinguish between noise and signal, between momentum and dislocation. Let me explain what registered inventory actually means. Think of COMEX as a bar, a very specific kind of bar. You can come in and order a drink. That's buying a futures contract. The bartender writes it down. You pay later. Most people never actually take delivery of the drink. They settle up in cash. The bar operates smoothly because everyone understands that only 2% of orders will ever be filled with actual liquid. But the bar still needs bottles behind the counter. Real ones. Because if someone demands their drink and the bottles aren't there, the whole system collapses. Registered inventory is those bottles, the physical metal that must exist to make the paper contracts credible. In early December, 60% of the bottles disappeared in 4 days. The official explanation will be that this was seasonal. December is a major delivery month for silver futures. High delivery volumes are expected. Market makers anticipated this. They planned for it. Everything functioned normally. Here's the problem with that explanation. December delivery volumes were elevated, yes. But when you compare the notional value, the dollar amount of physical silver claimed, it was 2.5 times higher than any December on record, going back 30 years. And this happened while silver was already trading at all-time nominal highs, meaning the physical demand was price insensitive. Buyers were taking delivery regardless of cost. That's not normal seasonal behavior. That's something else entirely. Let me show you how this system normally works. Silver futures trade on COMEX. Each contract represents 5,000 troy ounces. When you buy a contract, you're entering a derivative position. You don't own metal. You own a legal claim on metal. The exchange maintains warehouses, approved depositories in New York, Chicago, Delaware. Metal sits in these warehouses in 2 categories. Registered, which is immediately deliverable, and eligible, which meets quality standards but isn't allocated for delivery. Under normal conditions, the ratio between open interest, the total number of outstanding contracts, and registered inventory stays within manageable bounds. If open interest grows too large relative to inventory, the exchange can adjust margin requirements, raise the cost of holding positions, force weaker hands out, reduce leverage. This mechanism has worked for decades, but it relies on an assumption. The assumption is that physical demand remains a small fraction of total trading volume, that most participants are hedgers or speculators who will settle in cash, that delivery requests stay predictable. When delivery requests spike, when 60% of registered inventory gets claimed in 4 days, the mechanism breaks down, because you can't raise margins on someone who's already taking physical delivery. They're not levered, they're not speculating, they want metal. And if the metal isn't there, you have a problem that margin adjustments can't solve. Here's the calculation that risk teams are running. Start with registered inventory. As of late November, 113 million ounces. Now apply the December delivery surge, 47 million ounces claimed. That leaves 66 million ounces registered. But open interest in silver futures, the total contracts outstanding, represents approximately 244% of total vaulted silver, not just registered, total. When you isolate registered inventory, the leverage ratio becomes extreme. Every ounce of deliverable metal backs multiple claims. Under normal circumstances, this works because delivery rates stay low, 2% historically. But what happens when delivery rates rise? When they go from 2% to 5% to 10%? Let me show you the math. Silver futures open interest currently sits around 650 million ounces equivalent in paper contracts. If delivery rates increase from 2% to just 5%, that's 32.5 million ounces in physical demand per month. With 66 million ounces registered, you exhaust registered inventory in approximately 2 months. At 10% delivery rates, you're done in 1 month. This is where the math breaks. Because unlike gold, which accumulates in central bank vaults and private holdings, silver gets consumed industrially, permanently. Every solar panel installed, every electric vehicle manufactured, every semiconductor produced removes silver from the available supply. It doesn't return. Recycling recovers only a fraction. The Silver Institute estimates the market ran a deficit of approximately 117 million ounces in 2025. That's the 5th consecutive year of deficit. The cumulative shortfall since 2019 exceeds 1.3 billion ounces. When you're in structural deficit, every ounce claimed for delivery tightens the system. When the system is already tight, small changes in demand behavior produce outsized effects. This is where confidence matters. Markets are nonlinear systems. They operate smoothly until they don't. The transition between stable and unstable happens faster than most people understand. Think of it like this. You're standing on a bridge with 100 other people. The bridge is rated for 80 people, but everyone's been standing there for hours. Nothing's happened. So collectively, you assume it's fine. Someone invites another person onto the bridge. Still fine. Another person. Still fine. Then someone shifts their weight. Not much. Just a small movement. And suddenly everyone feels the bridge sway. Now people start moving toward the exits. Not running, just walking. But everyone's walking at the same time. The bridge sways more. Now people are running. The bridge didn't weaken suddenly. The bridge was always above capacity. What changed was perception, confidence. This is how liquidity collapses work. In silver, the bridge is the futures market. The weight is the ratio between paper claims and physical metal. For years, the system operated above its theoretical capacity because confidence remained intact. Participants believed that delivery requests would stay low, that registered inventory would be sufficient, that if problems emerged, the exchange would manage them. In December, 60% of registered inventory was claimed in 4 days. People saw the bridge sway. Now watch what happens next. When confidence breaks, market participants change behavior. Longs who previously settled in cash start demanding delivery. Shorts who previously rolled contracts forward start covering. The bid-ask spread widens. Liquidity thins. Price discovery becomes erratic. And because silver trades in backwardation, spot prices above futures, the market is already signaling physical tightness. Backwardation means immediate delivery commands a premium over future delivery. That's the opposite of normal commodity term structure. It indicates shortage. Stay with me. When a market is in backwardation and registered inventory is draining, you enter feedback territory. Lower inventory drives higher delivery requests. Higher delivery requests drain more inventory. The loop accelerates. At some point, the exchange faces a choice. Continue allowing physical delivery and risk exhausting registered stocks. Or restrict delivery. Force cash settlement. Both outcomes destroy confidence. If delivery continues and stocks go to zero, the futures market loses credibility. If delivery gets restricted, participants learn that paper claims don't convert to physical. Either way, the assumption breaks. Let me show you what's happening beneath the surface. Silver trades simultaneously in 2 realities, the paper reality and the physical reality. In the paper reality, silver is a derivative, a contract. You can trade hundreds of millions of ounces with a keystroke. Leverage is high. Liquidity, under normal conditions, is deep. Price movements follow technical patterns, momentum, fund flows. In the physical reality, silver is metal. It has mass. It sits in specific locations. Moving it requires logistics, carriers, insurance, vault space. Physical silver trades at a premium to paper silver. Sometimes a small premium, 2%, 3%. During stress, the premium spikes. In October 2025, during a liquidity squeeze in London, silver lease rates, the cost to borrow physical metal, hit 30% annualized. That's not a normal financing rate. That's shortage pricing. For years, these 2 realities coexisted. The paper market provided price discovery. The physical market supplied industrial users and investors. Arbitrage kept them aligned. But alignment requires the ability to convert paper into physical. When conversion becomes difficult, when registered inventory drains, when delivery delays extend, when premiums spike, the 2 realities diverge. And once they diverge far enough, they can't simply reconverge, because the trust that held them together is gone. Here's the critical point. We're watching this divergence accelerate. COMEX registered inventory has declined by approximately 70 million ounces since September. That's a 28% drawdown in 4 months. London vaults, historically the largest silver storage hub outside the United States, have seen inventory fall from 31,000 metric tons in June 2022 to 22,000 metric tons by March 2025, a 30% decline. Meanwhile, industrial demand continues rising. Solar installations are projected to hit another record in 2025. Electric vehicles require 3 times more silver than conventional vehicles. The average EV contains 25 to 50 grams of silver. Global EV production is growing. AI data centers, 5G infrastructure, medical devices, all silver intensive. And mine supply has contracted 7% since 2016, because 70% of silver comes as a byproduct of copper, zinc, and lead mining. When base metal prices weaken, silver production falls. But when base metal prices strengthen, it takes years for new mines to come online. The supply response is slow, inelastic. You have rising consumption, falling above ground inventory, and inelastic production. That's a recipe for shortage. Not eventual shortage, immediate shortage. The question is, what happens when the market fully prices this in? Let me walk through 3 possible outcomes. Outcome 1, everything normalizes. Delivery rates return to historical averages. New supply comes online. Industrial demand moderates. Registered inventory replenishes. Silver settles back into the $30 to $40 range. Probability near zero. This requires reversing structural trends that have been building for 5 years. It requires mine supply to increase despite declining ore grades and permitting delays. It requires industrial demand to fall despite green energy mandates and electrification trends. It requires investors to lose interest in physical metal despite currency debasement and inflation concerns. None of these reversals are happening. This outcome is fantasy. Outcome 2. The exchange intervenes. COMEX implements emergency measures. Position limits tighten. Delivery restrictions activate. Cash settlement becomes mandatory. The paper market continues, but physical delivery stops. Probability, moderate. The exchange has authority to do this. In March 2022, the London Metal Exchange halted nickel trading and canceled trades after a liquidity crisis. Exchanges protect themselves. If registered inventory approaches zero, COMEX will act. But intervention destroys credibility. The futures don't convert to physical, they're not derivatives, they're just bets. And if they're just bets, why trade them when you can buy physical? This outcome doesn't solve the problem. It moves the problem from the futures market to the physical market. Outcome 3, managed crisis. The exchange maintains delivery capability but allows prices to rise. Higher prices reduce physical demand. Rationing by price. Supply chains adjust. Some industrial users substitute. Some investors take profits. The market clears at a higher level. Probability high. This is the path of least destruction. It preserves market function while acknowledging reality. Here's what that path looks like numerically. Silver currently trades around $78. To clear the structural deficit, to balance supply and demand at current inventory levels, you need demand destruction or supply expansion. Demand destruction happens through price. Industrial users face substitution thresholds. At $50, some applications start using alternatives. At $75, more substitution occurs. But many applications, solar, electronics, medical, have no easy substitute. Silver's conductivity and properties are unique. So price has to rise until marginal demand equals marginal supply. Where's that equilibrium? Nobody knows precisely. But we can estimate if registered inventory continues declining at current rates, you reach critical levels by late Q1 2026. Call it March. At that point, either prices spike to ration demand or the exchange restricts delivery. If prices spike first, you're looking at a move to test previous resistance levels. The 1980 high was 49.95 nominal. Inflation adjusted, that's approximately $170 in today's currency. But this isn't 1980. In 1980, the Hunt brothers cornered the market through speculation. This is industrial shortage, structural deficit, different mechanism. A more realistic target is the level that brings enough profit-taking to offset continued industrial offtake. That's probably somewhere between $50 and $75 in the near term. By Q2 2026, that's April through June, $50 is not only achievable, it's conservative. Here's why. What this means for you is straightforward. Do not panic, do not chase. Understand the mechanics. The move to $50 isn't happening because of momentum or sentiment. It's happening because the physical market is tighter than the paper market reflects. And eventually, paper must reprice to physical. This is not a trade. This is not a speculation. This is watching a system under stress and recognizing that stress doesn't resolve downward when you're in deficit. The strategic mindset here is simple. Physical markets operate differently than paper markets. When you own physical metal, you're outside the fractional reserve structure. You're not dependent on an exchange honoring delivery. You're not exposed to counterparty risk. But physical also means accepting illiquidity. Premiums over spot, storage costs. These are real frictions. They matter. If you're positioned, you're watching for signs that the system is stabilizing or deteriorating further. Not day-to-day price noise. Structural indicators. Here's what to watch. First, COMEX registered inventory levels. These are published daily on the CME Group website. If registered continues declining below 50 million ounces, you're entering critical territory. Below 30 million, you're in crisis. Watch the absolute number and the rate of change. Second, delivery volumes relative to open interest. If delivery rates stay elevated above 5% of open interest, that's confirmation of persistent physical demand. It means the December surge wasn't a one-time event. Third, silver lease rates in London. These measure the cost to borrow physical silver. When lease rates spike above 10% annualized, that signals shortage. 20% is severe shortage. We hit 30% in October. If that happens again, it confirms tightness. Fourth, physical premiums. The spread between spot prices and retail bullion prices. Under normal conditions, premiums run 2 to 4%. During the 2020 COVID disruption, premiums hit 60%. If premiums start widening above 10%, that's physical scarcity showing up in retail markets. Fifth, Shanghai premiums. Silver trades in Shanghai as well as New York and London. When Shanghai prices trade at a sustained premium to COMEX, it indicates metal flowing from west to east. From paper markets to physical demand centers. That's structural shift, not temporary arbitrage. You don't need to check these daily. Weekly is sufficient. This isn't about timing. It's about understanding whether the system is moving toward equilibrium or away from it. Zoom out for a moment. This isn't just about silver. Silver is a signal. What you're watching is the breakdown of the fractional reserve model in commodity markets. For decades, futures markets operated on the assumption that physical delivery was optional, a feature, not a requirement. As long as most participants settled in cash, the system worked. But we're entering a period where physical matters, where counterparty risk matters, where the distinction between owning a claim and owning an asset matters. This shift is happening across commodities. You've seen it in nickel, in palladium, in copper. Markets where the paper to physical ratio exceeded sustainable levels and confidence broke. Silver is the most visible case because silver sits at the intersection of industrial commodity and monetary metal. It's consumed like copper, but held like gold. That dual nature makes it uniquely sensitive to both supply shocks and confidence shocks. And right now, both are occurring simultaneously. The broader implication is that commodity pricing is going to become more volatile, more fragmented, more disconnected between paper and physical. Investors who understand this will position accordingly. Those who don't will be confused when derivatives don't behave like the underlying asset. This is not alarmism. This is observation. When registered inventory drains 60% in 4 days, when 5 consecutive years of deficit accumulate to 1.3 billion ounces, when industrial demand continues growing while mine supply contracts, these are facts. Facts create outcomes. The question is not if silver reaches $50. The question is how long it takes and what breaks along the way. Because something always breaks. Markets don't reprice smoothly when confidence collapses. They gap, they dislocate. They create winners and losers in ways that seem arbitrary but follow mechanical logic. Right now, the mechanics point one direction. $50 by Q2 2026 isn't prediction, it's math. It's the clearing price for a market in structural deficit with declining available inventory. The uncertainty isn't the destination, it's the path. Whether we get there through steady appreciation or violent spike, whether the futures market maintains credibility or fractures, whether this becomes a managed repricing or a chaotic scramble. But we're going there. Pay attention to the registered inventory number. Watch the delivery data. Understand what you own and why you own it. This is happening now, not in theory. In warehouse receipts and clearing reports and exchange filings, the supply shock nobody's pricing in is already here. It just hasn't shown up in consensus forecasts yet. It will. If this analysis helped you understand what's actually happening in the silver market, not the headlines, but the mechanics, subscribe to the channel. I break down market structure, risk mechanics, and institutional flows that don't make the news but move the numbers. Drop a comment below with which indicator you're watching most closely. Registered inventory? Lease rates? Physical premiums? I read everyone, and your questions shape future analysis. Don't trade on emotion. Trade on structure. I'll see you in the next one.